Okay, first you look at the question, have a quick read. So you know that this is about first in, first out. Find out important information in the passage, and then it's about inventory. So this is an inventory topic with all the dates that what happened to our inventory. So first question said the valuation rule. So the valuation rule, you have to state the name of the theory, prudence, that is recorded at the lower between cost and net realizable value so that your assets and profit are not overstated. So that is your prudence theory. Okay, and moving on. Okay, prepare the inventory account. When we want to prepare account, we want to know the date, the particulars, the debit, credit, and the balance. So what happened? So to do the balance, to know what is the final amount, we need to do our debit credit. Therefore, let's do our quickly debit credit. So beginning inventory is just your balance brought down. There's nothing going on, nothing up, nothing down. Then followed by purchase, inventory, trade payable, purchase, inventory, cash at bank, and then sold by check. So it's cash at bank, sales revenue, cost of sales, and inventory. So do take note when we sell things, there are 4 accounts. Next one we purchase again, so it's inventory and cash in hand. Then we sell, so this one is on credit, so it's trade receivable, sales revenue, cost of sales, and inventory. Again, 4 accounts because we are selling. Then now the amount. Amount I think is pretty straightforward. So the value is 400. The value is 800. Now this is tricky when we have 4 accounts. So for 4 accounts, we are selling at this price. So this is a selling price, is our sales revenue. So this is 900. So what is the cost of sales and inventory? So we need to know that the cost of this item, we are selling is 60 items. That's why first in, first out coming useful. What you buy first, you will sell first. Therefore, it is this 60 units. So therefore, cost of sales is 450. Okay, then the next one, we are buying at 470, straightforward. And the last one, we are going to sell 130 shirts. Alright, and then the price we are selling it is 960, so this is our sales revenue. So what is the cost of sales? The cost of this 130 item will be where we buy it at $400. So with that, we prepare the double entry very nicely and write very neatly. So this is what we have. So special note again, the cost of sales you have to use first in, first out. So it's 450 and 400. And with that, to prepare the inventory account, all we need is to take note of what happened to my inventory, whether it's debited or credited. So I went to circle it, and I know my answer will be what? Debit, debit, credit, debit, credit. So you see, debit, debit, credit, debit, credit. That's it. And then you just copy the number. Balance brought down, no debit, credit is just what we have. Okay. Particulars is your opposite account. So it's trade payable, cash at bank, cost of sales, cash in hand, cost of sales. So trade payable, cash at bank, cost of sales, cash in hand, cost of sales, the same thing. And to calculate the balance, we just do our calculation. So for inventory is an asset, debit means plus, credit means minus. So 450 plus and minus, you get 1270. And remember to balance brought down. Okay, then our next question is here, where we need to write the journal entry for the adjustment in the value of inventory. So what happened? We have the inventory after the fire only worth $1,000, but our balance brought down previously was 1270. So prudence theory said that we have to record at the lower one, so it cannot be 1270 anymore. You have to take the lower one, which is 1000. So from 1270 to 1000, all we need to do is to minus it off. Therefore, 1270 minus 1000, the amount of loss is 270, and the double entry is impairment loss and inventory.